Okay, another phone call. So we also need to include in the partnership agreement um, voting information, who gets what share of the votes, and you always need an exit strategy. So information pertaining to dissolutions. Also information pertaining to partnership draws. Who gets how much money and how often? That should be in black and white in the partnership agreement. The partnerships are governed by the Uniform Partnership Act, and that is in default if you do not, as a partnership, draft a partnership agreement. The 1997 version of the UPA has been adopted by most states, including us in Illinois. What the UPA does, is states the partner's rights and responsibilities regarding share ownership, management duties and profits, um, detailing that the partners have right to any interest on any loans made to the partnership that excludes their initial investment. The partners have a right to what's called a guaranteed payment. I just talked about that a minute ago. And the partners do have full right to full access of the accounting records of the industry. So any partner in the partnership has the right to look at the books anytime they choose. So also, actually I lied. The guarantee payments is 2 slides out. The partner's responsibilities under the UPA, you share the losses. Your general partners have unlimited liability. There's also what's called a limited partner. And a general partnership has to have at least one general partner. It can have an unlimited number of limited partners, and those partners, their liability is limited only to their investment in the partnership. General partners, their personal assets are at risk. So you can kind of see why this choice of entity structure is becoming less and less popular. We have a better arrangement out there, and that's called a limited liability company. Partners, again, they're obligated to share all the information of the business, and disputes of the partners are to be settled by majority vote or by arbitration. Now we'll talk about guaranteed payments. Those are payments for work performed, made to the partners regardless of their individual capital balance. So the partner can have a capital balance of 0 and still get a guaranteed payment, and it does not, they don't have any taxable events in regards to partnership of capital balance. There is a taxable event to receiving a guaranteed payment. So guaranteed payments are not only subject to income tax, but also to self-employment tax. The same self-employment tax as was seen in sole proprietorship. And that's doubled Social Security. The rates are given down here, doubled Medicare. So employers match the employees' withholding of Social Security and Medicare taxes. The individual rates are 6.2% for Social Security, 1.45% for Medicare. So an employee would have 7.65% combined percentage for both taxes. They call that the FICA tax. So for both employer and employee, if you double that amount, you come up with 15.3%. And that amount is self-employment tax. Half of that can be deducted as an adjustment against an adjusted gross income, as basically like an expense deduction. So it's like deducting the employer's quote employer's expense for taxes, payroll taxes. Social Security has a wage base, and that is the first $137,700 of self-employment income, partnership income, sole proprietorship income, and wage income. So once an individual hits that amount, that 6.2% Social Security stops. Medicare tax, however, goes on and on and on. If you make $7 million a year, you pay Social Security tax on $137,700. You pay Medicare tax on $7 million. So net partnership income, guaranteed payments are allowed as a deduction in determining net income from a partnership. So net partnership income and guaranteed payments are both subject to self-employment tax and income, regular federal income taxes and state income taxes as well. So there are different types of partnerships. The most common is the general partnership, where all partners are actively involved in the partnership itself. They share profits and liabilities, and your general partners have an unlimited liability. In a general partnership, there are no limited partners. Limited partnership, you have a mix. You have some partners who are general, and they're treated as having no liability, have unlimited liability, and are the ones who are actively working in the partnerships. The limited partners, their liability in the entity is to the amount of their investment. That's the most they can stand to lose in something like a lawsuit. A general partner could be their personal assets are on the hook if they were to be sued personally. If the partnership were to be sued, they could be sued individually as well. So limited partners, they're just merely investors. There's also a couple of other types of partnerships. There's what we call limited liability partnerships, not available in all states, but are available in Illinois, and all partners in LLPs are treated as limited partners. And then there's also something called MLP, a master limited partnership. Those are traded publicly, and there is involved in that a master partner who owns 50% or more of the ownership interest. So different types of partnerships. There are different types of partners aside from general and limited. There are also partners called secret partners, silent partners, nominal partners. Basically, your first two partners do not appear as partners to the general public whatsoever. And sometimes to the other partners, they don't even know they exist. A nominal partner is an individual who's not at all a partner in the partnership, but appears to be to the general public. Dormant partner, just one who is inactive. And then there are senior and junior partners, and that has to do with how long those individuals have been owners in the partnership. So advantages of a partnership, they're relatively easy to set up. A partnership does need to apply for a federal ID number. So they do need to fill out an SS4. They would also need to register with the state. That can be done via My Tax Illinois. So pretty easy setup, and it is very much to your advantage to have a partnership agreement drafted by an attorney. You'd want to do that before anything else. Partnership advantages. Point 2, by having multiple owners, you can divide responsibility. You have some synergy between the partners. Maybe partner 2 thinks of a different angle of how to do something in the partnership than partner 1 does. So you got kind of 2 brains are better than 1. Multiple partners, you can raise more capital than you can in a sole proprietorship. And unlike a C corporation, there's no double taxation involved in a partnership. Same thing with a sole proprietorship as well. No double taxation there either. Disadvantages of a partnership. What if you have too many partners? Too many cooks in the kitchen can spoil the dish, right? So that can happen in business too. A partner dying causes a business continuity issue. Your general partners have unlimited liability. That's a big disadvantage. And point four, you are limited in terms of size, in terms of growth, as compared to something like a corporation, which can raise more capital, especially a publicly traded corporation. So the partnership tax return, what form does a partnership file? And that is Form 1065. And we'll look at that form in just a second. The due date for the calendar year partnerships. This has changed in recent years. The Forms 1065 formerly were due on April 15th for a calendar year partnership. In not the last, I can't remember exactly what year, but at least the last 4 to 5 years, that due date was actually bumped up a month. So instead of 4/15, now the due date for calendar year partnerships is March 15th. And the reason being is so that schedules K1, which carve up your your partnerships, income and expenses, so that can be issued to the partner in a timely fashion. So that Schedule K1 tells the partner what net income they claim, what guaranteed payments they claim on their personal tax returns. And the reporting of Schedule K1 happens on the second page of Schedule E. So we'll look at that as well. We're looking at a Form 1065. Again, the hyperlink will take you out to a PDF that's located on the IRS's website. And that PDF is the Form 1065, which is the partnership, U.S. return to partnership income. And these are, as you can see from the beige ribbon at the top of the screen here, I use a different PDF creator than Adobe. But these forms on the fields on the forms that come from the IRS's website, they are fillable forms. So you can actually type in these forms and save them and print them, etc. But so your U.S. return of partnership income, the first page is basically business information from line A through line K. Income statement starts on line 1. It looks a lot like a Schedule C. And your deductions also look a lot like a Schedule C, just some of the names of the line items are going to be different. Things like line 10, guaranteed payments to partners. We're not going to see that on a Schedule C. Schedule C is not for a partnership. So then we have total deductions and ordinary business income and loss. Schedule K will pick up some of the information from page 1, as well as some information that comes from different areas. Page 2 of 1065 just asks some general information. What type of entity is this? What type of partnership? Some yes and no questions. Did anyone, did the partnership own any, 50% of any corporation? If so, what is it? Some general questions. Like line 4 is asking whether or not the entity has to complete some of the back pages of this return, which are a balance sheet and an analysis of capital accounts. Asking whether the partnership's publicly traded, etc. It's just some general yes and no questions. And then some more on page 3. Your partnership representative is listed here as well. So Schedule K picks up items from not only from line 1, but from some supporting schedules. And this Schedule K is the basis of the partner Schedule K1s. Basically, our items from Schedule K multiplied by the partner's income sharing percentages is going to give you your Schedules K1, which are distributed to the individual partners. But the only thing that won't be multiplied by their percentage of ownership is the guaranteed payments. And those guaranteed payments are going to be how much did partner A actually receive in guaranteed payments? How much did partner B receive in guaranteed payments? That's how much income those individuals would need to pick up on the return, as well as the net income from the partnership as well. So page 4, Schedule K. Schedule K actually ends at the top of page 5. We have an analysis by partner type. That's basically saying how many K1s are going to be generated for the year. Schedule L is a balance sheet per books. And Schedule M1 and M2. Schedule M1 reconciles net income per books with net income per return, which can differ by things like accelerated depreciation claimed on the tax return, where book methods utilize straight line depreciation. Travel and entertainment, maybe half as deductible as a tax expense, but the full 100% was deducted on the books. So this is a reconciliation schedule. And then M2 is an analysis of partners' capital accounts. The balance, the ending balance on line 9 should coincide with the ending balance of the partner's capital accounts on line 21 of the balance sheet. And basically your assets have to be $250,000 or more, and your receipts as well, in order for a partnership to be required to fill out Schedules L, M1, and M2. So that's a partnership tax return. And so that partnership tax return, Schedule K, gives birth to Schedules K1. Schedule K1 for a partnership return looks like this. And it's got the same, the line items, the line descriptions are the same. The amounts that would be reported would be line K or Schedule K, same line, times ownership percentage. The ones that will differ will be line 4A, guaranteed payments for services. Say this is, partner 1. Partner 1 received $40,000 guaranteed payments. So partners 1K1, partner 1's K1 would report $40,000 of guaranteed payments for services. So the left side of the Schedule K1 is information about the partnership, information about the partner, and the ownership percentages beginning and ending for that individual partner, their share of liabilities, and a reconciliation of their personal capital accounts. In a sole proprietorship, you don't have just one owner's equity account. You would have multiple owner's equity accounts, one for each partner. You'd also have a draw account, one for each partner. Guaranteed payments account, one for each partner. So that K1 becomes what information is reported by the partner on their personal tax return. And that individual will report their information using Schedule E, which is, as you'll see, typically used for rental properties. Page 1 is where you detail income and expenses for rental properties. Page 2, however, allows you, oh, I got the instructions. But page 2 of Schedule E allows for deduction, reporting of Schedules K1 by entity type. Whoops, oh, not Schedule 3, Schedule E. Ah, darn it, I can't type today. E, not 3. Okay, so Schedule E, Form 1040, right here. There we go. Here we go. This is a Schedule E. So you can tell the first page. Oh, got it. Ah, it wasn't my problem. It was the IRS's problem. They've got a bad hyperlink in there. So Schedule E, Form 1040, right here. This should lead us to it. There we go. That's better. So this is, it's actually called Supplemental Income and Loss. The first page is for, allows you to detail information regarding 3 rentals, 3 rental properties, or rents and royalties. Page 2 of the form gives you a place to report the information from a partnership or an S corporation, K1, you know, how much income or how much loss did you receive per K1. You got space to report 4 different income from 4 different partnerships, corporations. So detail from 4 schedules K1, forms K1. There's K1. And also the same for estates and trusts. Those also issue a K1. So the total income is in addition to income on the individual's tax return, and will also be included on Schedule SE to generate self-employment tax. Sorry about the bad link, guys. So income tax and self-employment tax is due on net partnership income and on guaranteed payments. And as I mentioned before, that amount can get pretty substantial quickly. The regular income tax can be as low as 10% and as high as 37%. Then add that to self-employment tax, and it doesn't take a whole lot to reach $1,000, and that is the threshold for when an individual needs to make estimated tax payments. When you have $1,000 threshold for sole proprietorships and partnerships, there is no withholding. You send your own withholding in, and that's an estimated tax payment. So 4 vouchers are sent in, or you can use EFTPS to send your payments. The due dates are April 15th, June 15th, September 15th, and January 15th. So steering away from partnerships to corporations. What is a corporation? Again, we're for-profit entities, one or more individual investors. Ownership interest is going to be divided into shares of stock. Those investors own one or more share of stock. A little more legwork involved in a corporation. You have to actually come up with articles of incorporation and do some paperwork with the Secretary of State's office. And Illinois Secretary of State office, the website is cyberdriveillinois.com, and you can actually go out to that website and do corporate work. You can articles of incorporation. So this is where you can use this website to start your corporation. You can actually file the articles of incorporation yourself. And the first step is picking a corporate name. Has to be unique. If I were to pick something like something that's already taken, the articles of incorporation is going to let me know. I will pick one that I know exists. Because that is the name of corporation right now. I'll get whoa. Has to contain one of the following words or abbreviations. Because I had PC, professional corporation, it did not let me do that. And it's not going to budge. Incorporated. And that one is, it's got to be unique. So. There's already a business that is pretty darn close. And if you sign off on that, then just know you might be confused for that other entity. I can apply for my articles of incorporation by filling out the rest of the fields. You get to a place where you have to pay a fee. That's available through this website to pay the fee online. The other option is to fill out the paperwork by hand and actually take it down to the Secretary of State's office in Springfield. You actually get your articles of incorporation like right away that way. But it's not much of a wait. I can tell you if you do that online, it's by the end of the week, you'd have articles of incorporation. So it is a pretty quick process online. So corporation characteristics, you have a limited liability. That is the big selling point right there, is that limited liability of shareholders. Your state gives you your charter, and in that articles of incorporation, you as the incorporator are telling the Secretary of State's office, this is how many shares I want to have authorized, this is how many shares I want issued. You want to take any change to that, you have to fill out additional paperwork. One huge benefit with corporations, especially as compared to sole proprietorships and partnerships, they have an indefinite life. The death of a partner does not mean the end of the entity. Like we have corporation at my office, my father passed away, the corporation did not end when he passed away. Corporate shares can be purchased privately, such as with my company, publicly, such as with companies like Caterpillar, General Motors, Tesla, about any company that's traded on the stock exchange that's a corporation, that's publicly traded shares. Public trading, there's additional requirements that are involved in that, and they all are costly. So what kind of different corporations we have? Foreign does not mean in another country. In this, domestic has to do with I'm registering as a corporation in Illinois, doing business in Illinois. So I'm an Illinois domestic corporation. If I registered in Illinois, but I were doing business in Iowa, then that in Iowa is a foreign corporation. An alien corporation is when the business was incorporated in a different country entirely. So the requirements in Illinois and your initial corporation, your articles of incorporation can be filed online at CyberDrive Illinois, what I was just illustrating. You can also deliver those to Springfield. And there's a fee involved. And also involved in corporations was an annual filing requirement. So to maintain your corporate status, you have to fill out a very short form annually. Reports any changes to shares issued, business ownership, physical location, things like that. There is a fee involved, and it's a minimum of $100, and that is paid annually. And online filing and online payment is also available for the, for the recurring payment. What? Okay, hold on just a second here. Back to, there we go. Okay, so our initial corporation, again, we can either do it online or deliver to Springfield to the Secretary of State's office. And the annual filing requirement, same thing, online, or you can actually mail them into the Secretary of State's office as well. So after incorporation, you get a certificate of incorporation that's going to include the name of the entity, the mailing address, the purpose of the business, industry classifications, officer information, etc. So corporations in their organizational structure, you have shareholders who elect a board of directors. That board of directors is the ultimate responsibility of the business. The board of directors are not paid, they're not W-2 paid employees. They're generally paid a fee via Form 1099. So they're paid a board of directors fee. It's just they're paid as independent contractors. So the board of directors elects a corporate president. The president is that individual who appoints the other corporate officers, such as the vice presidents, the secretary, etc. Maybe the assistant vice presidents. Shareholders have voting privilege. If the shareholders can't be present at the meeting, they can have someone at the meeting vote for them. That's what's known as a proxy. And if you own shares of stock, you might have received a proxy in the mail before. So corporations, I alluded to it earlier on, there's Our types of corporations are C or S corporations. Subchapter S corporations haven't been around as long as C corporations, and they have some hybrid features that to where the tax treatment is kind of a blend of corporation and partnership. Actually getting pretty popular. It's taking away some of the popularity that partnerships once had. So C corporations, most common type for your larger businesses, especially those that have more than 100 shareholders. A corporation, a C corporation, has its own tax structure. And prior to the Tax Cut and Jobs Act of 2017, the top federal tax rate for corporations was 35%. Now it's 21% flat rate. And that was effective 1/1/18. Illinois, we also have a state income tax rate for corporations, and that was 7%, and that was effective mid-year of 2017, and that remains the case today. C corporations, there is double taxation, and what that implies is in the area of dividends, there is no expense deduction allowed for the payment of dividends by corporations. So the corporation is paying tax on that money. The dividends become income to the shareholders, and they pay income tax on that money as well. So there is income tax paid on the amount of dividends twice. So that's why it's called double taxation. There is an alleviation for triple taxation, and that is what if a C corporation owns shares in another C corporation and receives dividends. There's something called a dividends received deduction that helps alleviate some of what could be seen as triple taxation. So C corporation tax form used is a Form 1120. It's going to look a lot like a 1065 with just some different line items and not as many questions on the second and third pages. But the due date, and this is always a little wordy how the IRS has worded it, but the due date is the 15th day of the third month following the year end. So if you have a calendar year corporation, year end is 12/31. The Form 1120 would be due on April 15th. And that due date changed at the same time as the partnership returns due dates changed, because 1120s used to be due you got 2.5 months after year end. And so now the 1120s got pushed out. You got an extra month to file. Partnerships got one less month to file. S corporations were not affected. So S corporations, they're called subchapter S corporations, came about in 1954, but didn't gain popularity until much later, really until about the 70s. The tax on the entity net income, the benefit of those is what was 21% for a C corporation could be as low as 10%, because that tax on the entity's net income is the income is passed through to the shareholders and taxed at that shareholders' individual income tax rates. Could be as low as 10%, could be as high as 37%. And there's 7 rates based on filing statuses and taxable income. Illinois' income tax rate is 4.95%. To qualify for an entity to qualify as an S corporation, it must meet requirements, which will be detailed on the next slide. And there is a deviation of the Form 1120 called the 1120S, which is really like a hybrid between the Form 1120 and the 1065. So we'll look at Form 1120S real quick here. And looks very similar. Form 1120 will look a lot similar to this. Hang on, there we go. So again, first part of the form, first part of the return is for business information. Lines 1 through 6 are your income. Lines 7 through 21 are your expenses. Or line through 7 through 20 are your expenses. Net business income is line 21. Okay. So a lot fewer questions on pages 2 and 3. What took up 2 entire pages on a partnership return only takes about a page and a quarter on an 1120S. So your Schedule K1, similar to your partnership Schedule K, will be the basis of your individual shareholder Schedules K1. And this time they will be multiplied by Schedule K1 times shareholder percentage. That is, it's about as easy as it gets there. Balance sheet per book starts on page 4. Looks very similar to the balance sheet on Form 1065. Just the names in the equity section are going to change, and you're going to see mentions of shareholders rather than partners. So it's, the verbiage is just a little bit different. And then there's also a Schedule M1 and a Schedule M2, much like your Form 1065. So basically, it's the hybrid form of partnership and corporation. An S corporation K1 gives the information, the income to be reported by each shareholder. And again, it utilizes the second page of the Schedule E, just like a partnership did. So left side, details information about the corporation and the shareholder. You don't, however, have all of the beginning and ending ownership percentages. You don't have your reconciliation of basis. None of that is present on an 1120 Schedule K1. Okay. So S corporation's requirements to be able to be treated as an S corporation, your entity must have been incorporated within the United States. There must be 100 or fewer shareholders who are all US citizens or permanent residents. Your shareholders can only be the entities listed. No more than 25% of your income can come from passive investment income sources in any 3 consecutive years. If that's the case, S Corp status can be lost, then entity becomes a C corporation and taxed at potentially higher levels. And S corporations can only have common stock, no preferred stock. The form used is what's called a 2553. Any newly formed entity would do that at the time of forming. Any existing C corporation, if they qualify, can convert to an S corporation, and it can be retroactive to the first of the year if you fill this form out by 75 days within the new calendar year. So if in 2021, I decide I want to be an S corporation for calendar year 2021, I have to complete and submit this 2553 no later than March 15th, 2021. Then that election would take effect 1/1/21. So you put your business information in part 1. What is your selected tax year? Do you have a calendar year end? Do you have a fiscal year end? Who are your individuals? If your election is late, here's my reasonable cause. And there are a lot of reasonable causes which can be accepted. Things like, disaster declarations. We've got a perfect one here in the COVID case. So officer signs on page 1. Also, all of the individual shareholders are listed on page 2 in part 1. And given is enough information just to fill up one page. Well, you might have a corporation that has 100 shareholders. If so, not all of those individuals are going to be listed here. So you have, there is a continuation form. You can use additional copies of page 2 until you get as many forms to accommodate the number of shareholders you have. So listed is the name and address of each shareholder and their social security number or employer ID number, the shareholder's tax year ending. If it's an individual, then 12/31 is a shareholder's tax year end. And then each shareholder, not only name and address and social security number and year end, they need to list for each shareholder the number of shares they owned and the dates acquired. And each shareholder has to sign this form separately. So if you got 100 shareholders, you got to round up 100 signatures in order to complete the form 2553. And you've only got 3.5 months to do that, and that form needs to travel. You could be playing beat the clock. So that is the paperwork to apply for an S corporation. Once that is accepted, you'll get a letter from the IRS saying that your corporation qualifies as an S corporation, effective date 1/1/2021. And if any, after filing the first corporate return, if there's ever any question from the IRS, well, we never got a form 2553, you can send them a copy of their letter and say, yes, you did, because here's my proof. And it does happen, not as much as it used to. So corporate advantages, just in general, they can be C corporation or S. Indefinite life, limited liability. You have increased ability to raise capital, and especially for your publicly traded corporations. Some of those corporations that took the PPP loans and ended up paying them back. One of them was Potbelly Corporation that has the Potbelly sandwich shops. Another one, company called the Shake Shack. Both of those entities just said, okay, we'll just issue additional shares of stock instead of accepting a PPP loan. So ability to raise capital. You need to raise money for a big project, issue some shares. Ownership shares can be transferred. That doesn't have anything to do with your corporation. A shareholder sells their shares, your corporation doesn't cease to exist. Someone else will buy the shares, or they're held by the corporation itself as what's called treasury stock. Larger corporations, such as your Caterpillar and your Apple and Amazon and companies like that, Microsoft, they have the ability, because they have the money, they can attract and retain highly skilled management, highly skilled employees. They've got the best of the best because they can afford it. Disadvantage of corporations, the double taxation of dividends. Just forming a corporation itself and recurring operation, it's going to be more involved of a process. Not only do you have the paperwork with the Secretary of State, but there's corporate minutes requirements. And banks are looking at this nowadays. If you open a new checking account at a bank, some of them want to see your corporate minutes, which is a little hard to come by if you are a one-owner corporation who doesn't have meetings. You don't have meetings, you better come up with some minutes, or you're not going to get a bank account. So you have your annual report requirements with the Secretary of State. You have your tax return filing requirement as well with the IRS and the Department of Revenue in which your corporation exists, which state. Some of the additional requirements for publicly traded corporations, your financial statements have to adhere to generally accepted accounting principles. You also have the requirement of having to have an independent audit done, which can be costly. And there's also quarterly filing requirements and annual filing requirements with the SEC, which also come at a fee. So it's not cheap to offer your stock for sale on a stock exchange, but it can bring a lot of capital. But there are costs that go with it. So this comes right out of the book and shows some of the main differences between C and S corporations in terms of voting privileges, taxes, ownership range, public versus private, where can they do business. S corporations maybe aren't available in certain states. C corporation, there's no limit on the number of shareholders you can have. Caterpillar has millions of shareholders. S corporation can only have 100. C corporations can have private stock, public stock, or common versus preferred stock. S corporation, they can only have common stock and only one class of that. So in terms of entity type, even though corporations are smaller in number, they are the major players in the field. Of all the dollars of revenue earned by any entity in the United States, 87% of revenues are earned by corporations. And in this case, the textbook combined C and S corporations into one. Partnerships are second, sole proprietorships are third. So the major players in the game are the corporations. Your profits by entity type, where corporations might make more revenue, they're not as profitable as partnerships and sole proprietorships. They do have additional expenditures, such as those annual audit requirement, having to pay higher salaries and more benefits to their employees. We have some other forms of business ownership. Just a second here. Okay, my laptop decided it was going to die on me. So, okay, now we are back in the business here. So our other forms of business ownership, limited liability corporation, that has actually caught on with popularity in the last 15, 20 years, especially. Professional service corporations, joint ventures, not-for-profit organizations. The textbook used a different abbreviation for not-for-profit organizations, but they are called NPOs, actually non-profit organization. And cooperatives, which are more commonly seen in the farming industry than they are anywhere else, but they are gathering popularity. The limited liability company is a hybrid type of entity, which is relatively new. It was not in all 50 states until about 1996. Can't remember who the last state was to adhere to having limited liability companies. But you file something with your Secretary of State called not Articles of Incorporation, but this is called Articles of Organization. And it's a similar process, though, to filing Articles of Incorporation with the Secretary of State. You do have flexibility in your entity structure. By default, your one-member LLC is a sole proprietorship. You can decide to change that. You could change to a C Corp or an S Corp. To change entity classification with the IRS, you have to file what's called a Form 8832. And that is filed with the IRS. And it is this form here. Once it comes up, there were some new mailing addresses last year. And it's a very simple form. You just say what your entity information on the top. I would like to change my current classification. I'm going to initial classification by a new entity. I've just formed an LLC. I want to form this LLC as what kind of entity? The entity options are on the second page. I want to be a corporation. If you have an LLC and you wish to be taxed as S corporation, it's a two-step process. So you'd have a domestic eligible entity electing to be classified as an association taxable corporation. That would be step one. Step two would be filling out that Form 2553 to be taxed as an S corporation. So 2 steps necessary to get to S corp status for an LLC. If you wish to just be a C corp, checkbox 6A would do it. You wouldn't have to go the additional step. So, and the shareholders have to sign it. Or the shareholders, not the shareholders. In an LLC, the owners are called members. So the members would have to sign off, just like was the case with an S corporation. Your members have to sign in agreement to change the entity structure of the company. So some of the LLC benefits, an LLC, you do not have to do corporate minutes, and that is a huge one. You have that flexibility of entity taxation, coupled with limited liability of owners. So you can have, under an LLC, you can be a sole proprietorship with limited liability. So that's fantastic. The main disadvantage with LLCs is the fact that they've only been in all 50 states since 1996. There's differences that exist from one state to the other as to how they're treated in terms of lawsuits, everything. Tax-wise, I mean, there's no uniform LLC treatment. And who knows, someday we will probably get there. So some of the other forms of business ownership covered by the book: professional service corporations, and IRS kind of picking on us in the service business, where the shareholders are themselves licensed in their profession. Examples: medicine, law, accounting, financial planning. On our net incomes, instead of 21% federal tax, it's 35%, which is lovely. The thought is that the the professional service corporations should pay most of their income out in salaries. So you want your if you have a professional service corporation, The closer you can get to netting out to zero, the better. A joint venture is another type of business ownership. You have two or more entities that couple for one or a few projects only. You know, like your NFL and maybe, you know, something like Subway or Pepsi or, you know, Coca-Cola, the joint venture for, you know, the Super Bowl. Nonprofit corporations or nonprofit organizations, NPOs, they're charitable. They exist for a nonprofit purpose. The most common purposes you see are charitable, educational, civic, religious. So things like your animal shelters, your religious organizations, things like, you know, the Altruisa Club, or some fraternities and sororities do this as well. There's additional paperwork that needs to be completed to receive nonprofit status. Not only additional paperwork with the federal government, but also with the state. And there's also annual reporting requirements. There's what's called a Form 990 for a not-for-profit entity, and there's variations on that form as well. There's a 990T, there's a 990N, there's a 990 postcard. There's a few variations. A PF for private foundations. So there's a few offshoots of the Form 990. And that's due 4.5 months after the entity's year end. So if you have a calendar year non-for-profit, that 990 is due 5/15. And the last one covered is cooperatives. Most commonly seen, especially in this area, for most commonly seen in this area in agriculture. So you have, you know, an agricultural co-op that's an entity that's, you know, owned by, you know, some of the farmers in the area, own a business that, you know, does the drying and storing and warehousing of the grain. They not only get their income out of the cooperative, but they also get dividends, patronage dividends, and that's called a 1099 PATR is the form that's issued there. And we're also seeing cooperatives in terms of retail, like cooperative buying clubs. So a couple of topics to hit on Chapter 17, not too many, because the taxes and forms of business ownership, we've covered a lot of that already. I merged a lot of the Chapter 17.7 content into Chapter 4, into the PowerPoints presented. So 17.7 talks about some of the pass-through or conduit entities. Conduit was not mentioned in the book, but that is another term for these types of entities. And it is your entities who have a Schedule K1. The income and the expenses flow through to the shareholders in this case, or the partners. So partnerships, S corporations, generate forms, Schedules K1, and then the income is taxed at the individual's regular tax rate. Things like charitable contributions are taken as deductions on the individual's tax return, as itemized deductions potentially. The pass-through entities, your income can be taxed as low as 10%, as high as 37%, whatever that individual's marginal rate is. You can have 4 different shareholders in an S corporation with the same income, but that income is taxed at 4 different income tax rates because those people have 4 different tax situations. Sorry. So again, our corporations, to go back a few slides, well, more than a few slides back, effective due to the Tax Cut and Jobs Act of 2017, abbreviated as the TCJA. Corporations used to have a graduated tax system with rates as low as 15%, as high as 35%. That's been done away with, that structure, in favor of a flat tax of 21%. And that's been the case since 1/1 of 2018. So that being said, the illustration that's in the book is no longer accurate due to changes in tax law. Since the publication of the textbook, the TCJA changed a lot in terms of not only corporate tax rate, but individuals as well. So I did a modification of Table 17.7 that reflects current tax law. So what we had here was $75,000 of taxable income for a business. It was either going to be that $75,000 was either going to be paid out in taxes, in corporate taxes, or paid as dividends to the shareholder. So $59,250 for the traditional form of business, which is our C Corp. Column B is our C Corp, column D is an S Corp. So column B, traditional form of business, we would have paid corporate income tax at the rate of 21% on $75,000. Those individuals who earned the dividends would also have to pick up that dividend income of $59,250 on their personal tax returns and pay income tax on it again at the individual level. So assuming those individuals had a marginal tax rate of 22%, the total taxes paid on $75,000 is $28,785 for a C corporation, or 38% taxes to earnings, which is a lot. If in turn that corporation was an S corporation, the dividends don't matter. It's all going to be treated, the taxable earnings is going to be treated entirely as income on the individual's personal income tax, on their personal tax return, and possibly enjoy a little bit of a dip in tax rate as well. So for personal tax rate for D is maybe 15%. The personal taxes is going to be the only thing paid and not corporate income taxes. So you're going to be saving at least $15,750 in total income taxes. So in this instance, S corporation is the way to go. Not necessarily always the case. There's some instances, well, cases where you have more than 100 shareholders where that just cannot happen. You can't have an S corporation because you don't meet the requirements. So some of the considerations and strategies given in the book, they got a little overly verbose, in my opinion. But what it really boils down to is a situation tax avoidance or is it tax evasion? If something is tax avoidance, that's okay, because that's legal means to minimize tax liability. Even though it sounds a little questionable because of tax avoidance, it's not. Tax evasion is what's illegal. And that's illegal means to completely evade taxes, such as cheating and false documentation, concealing evidence, and one the book didn't report, not reporting cash received. That's tax evasion right there. What got Al Capone? It wasn't his mob crimes, it was tax evasion. More considerations and strategies. The main one really hinges on what's called the 179 expense election. And that is involves depreciating fixed assets. So what is depreciation? And I don't believe this definition was in the book, but it's a systemic allocation of a portion of an asset's cost to expense over the estimated useful life of an asset. So tax law methods, generally they do differ from book methods. So that, back in those entity tax returns, like the corporation, the partnership return, there was that reconciliation of book to net income, book income to tax net income. Depreciation is generally one of the adjustments. Book depreciation is generally straight line, where it's an even amount of depreciation over an asset's useful life every month it's in service. Tax uses different methods. Tax law methods, they depend on the class life of the asset in question as well as the nature of the asset in question. If you have a building, it can be taxed in two different ways. Does somebody live in there, is the question. If yes, if it's a residential rental, it's 27.5 years straight line depreciation. If no, nobody lives in that building, that same building, 39-year straight line depreciation. So it's all trying to come up with, how much expense has been utilized. So something like a 7-year class asset would, your shorter depreciation, things like, your computers, your equipment, trucks, things like that, use more accelerated methods. And most common is what's called makers. And makers uses different methods, a double declining balance switching to straight line. So that weird little double declining balance method that you might have studied in Accounting 157, it comes to life in tax. But what's avoided in tax is any recognition of book value. That goes completely out the window on a tax return. So there is something called Section 179 expense election, and that is available if in the tax year, your company places in service less than $2.5 million of qualifying property, 2.5 million or less. Then the corporation is allowed to take a quick write-off or 179 expense election of up to $1 million of cost of that asset. And those numbers do vary from year to year. Sometimes there is an uptick, as was the case, I believe, in 19, to help stimulate the economy, encourage the purchase of additional fixed assets, because there is a tax deduction allowed. I get a tax benefit for purchasing a new piece of equipment. Yes, I'll do it. I can expense this piece of equipment a lot faster using 179 than I could. That's depreciation. 1 year versus 7 years. I'll take one. Especially when you can carry any losses forward. Okay, so that concludes our week 3 material. As noted in the syllabus, there is a startup forms project. So what we want to do is locate on the IRS's website the instructions for Form SS4, which is application for employer identification number. So if you go out to irs.gov, there is a search box right in the dark blue ribbon. You can just type in like SS4 instructions. Oops. hit enter or hit the little magnifying glass to look. And lo and behold, there's instructions for Form SS4. And it's a 6-page file that just gives you some general instructions, how to apply for a federal ID number, what's the purpose, and how you file, what kind of information is required, is there a fee involved? This is all covered in the instructions. So what questions need to be answered? After you read the 6 pages of instructions, we just need to answer to the following 6 questions. What is an employer identification number and how is it formatted? The second question is how much does it cost to apply for an EIN? Third question is how many EINs may a sole proprietorship have? 4, what are the methods of applying for an EIN? Do you have to do it online or are there other methods available? And if so, what? What are the benefits to a sole proprietorship applying for an EIN even if there are no employees? Hint, we covered this in the PowerPoints. And what are some of the type of entities which have EINs? And it could be a sole proprietorship who has employees or who asked for one. So this is also available. There's a Word document up on the week 3 section here of our page, the week 3 startups form project. This is just echoing the same exact information that's on that last slide, or the next to last slide. So then for next week, due will be our startup forms project, as will be quiz 3. I should have that possibly done by the end of the day today. This is the 14th, Monday, so we'll have it by the end of Monday. If not today, tomorrow will be quiz 3. There'll be reading. Chapter 6 will be financial statements and their analysis. And our first mini research paper will be assigned next week, and we'll cover balance sheets. If you have any questions, please let me know. I'm available via email, text message, chat via Sakai site, or whatever method you would like. Google Hangouts. I'm pretty flexible. So I hope you have a great week 3, and hopefully we will see everyone in person. Or no, wait, we have another week of online coursework. So we're online next week as well. I almost have being back on campus next week. So we will see you next Monday in this format. So hope you have a great week.